We have a long-standing partnership with Progressive Wealth, I think with ourselves and with Allan Gray. They've been in the industry for quite some time, and we certainly value the opportunity to be able to have a talk to end investors at any point in time and hopefully add some value. So what we're going to do today, this is the second part of the series, so to speak, Navigating Through Uncertainty. And the objective really is to give an update on where we see things at the moment, how we see the world, and what's actually going on out there, and also then what we're doing in our portfolios. And I'll leave you with a couple of closing thoughts. So let's kick off with the global macro environment. And I think if you have a look at that little picture on the left there, that pretty much says it all. You know, that's the focus of what's going on out there, what's driving markets at the moment, and certainly what's driven the crisis that we've been going through. So I thought I'll start off just with a couple of basics, because it does lead into our views and where we see things at the moment. So coronavirus, the things that we do know are that there are very low mortality rates, lower than some of the previous viruses and infections that we've seen over the last few years. Estimates somewhere between 1% and 3%. Those seem to be revised down as governments and countries all over the world find out that more people are infected than those that they've tested. And most of the people that have been infected actually experience very mild illness. But it's extremely infectious. And that's really what's caused this very rapid spread throughout the world. And the biggest impact on the world at this point in time has been the reaction to that spread, as opposed to the spread itself. So while the loss of life is always tragic, the total numbers that we've seen thus far are probably only a taste of what's to come. But the reaction that we've seen economically, which we'll speak about just now, has been quite significant. So very last point then is that the only way that we see out of this at this point is probably a vaccine, and that's probably going to take somewhere in the region of a year to 18 months. So we do need to wait for that. We've spoken to a number of epidemiologists since the beginning of the outbreak, and one thing is absolutely clear, is that no one really knows exactly how it plays out from here. There are still a large number of unknowns about the virus and about its spread that still need to be answered. And until those are answered, it's going to be very unclear as to what the next steps are. A lot of the viruses that we've seen in the past were contained, they burnt themselves out, and they mutated. It doesn't look like that's going to happen this time around. So it does mean that we are going to have to wait for that vaccine for this crisis to play out. We have seen a number of countries in the world, all over the world at the moment, implement some form of lockdowns that has mitigated the spread of the virus to some extent, or constrained the spread of the virus to some extent. But the reality is that as soon as the lockdowns are lifted, the chances are quite high that you will see second round explosions in terms of infections again. So having said all of that, I think our base case at this particular point in time is that this is still going to last for at least another year until we see some form of vaccine. So it's now a global pandemic. We've got a number of countries in lockdown. The view that we've got at this stage, and I think which most of the world understands at this point in time, is that there will be a deep global recession as a result of those lockdowns, as a result of this crisis. And that's going to have a fairly big impact. And I think that it's probably largely underestimated in terms of the time it will take to get through that. But it is going to have a global impact, and we certainly are going to see big revisions in terms of economic growth, downward revisions. We've already seen the IMF come out with a revision this week saying that it's going to be worse than what they initially forecast. So expect more of that to come. And the reaction that we're seeing from governments and policymakers at this point in time has been rapid, and it has been vast. So the stimulus that you've seen into markets over the last few weeks has actually been bigger than what we saw during the global financial crisis, to give it some perspective in terms of how much we've actually seen. And the movements that we've seen in markets themselves have also been rapid, and they've been fairly large. So we've seen drops, declines in the market that have been quicker than anything we've seen before. And that's as a result of a lot of information disseminated very quickly throughout the world, and people reacting to that. Now, having said all of that, we do think that there will be quite a snapback in economic activity once all the lockdowns are lifted. And a lot of surveys that we're seeing at the moment in various different countries where they're asking people, what are the things that you're going to do when the lockdown is lifted? Pretty much everybody wants to go out and spend one way or another. They want to travel, they want to spend money. So I think that from a retailer's perspective, that's going to be quite positive. So just to give an idea of what various countries have done, if you look at all the little red crosses there, red crosses basically mean completely locked down or closed. And you'll see that non-essential shops, bars, restaurants, schools, anywhere where there's the potential for a mass gathering, borders, it's all pretty much closed at this point in time. And that has quite a big impact on the economies of the various countries in the world. This is a forecast from JP Morgan, and on the right-hand side there, you can just see, I don't know if you can see my cursor, that big drop, sort of pretty much in line with what we've seen from the global financial crisis. This is what's anticipated, but you can also see that snap back again, pulling us right back up again. So the question is just whether that's going to snap back that quickly or whether we sort of trundle along here for a little while longer. We think that there is a pretty good chance that you are going to see quite a quick snapback, but bottom line is that there is going to be a fairly protracted or fairly severe recession that we'll see in the short term. So what have we done in our portfolios as a result of this crisis? So one of the advantages we had was that towards the end of last year, and 2019 was a very good year. It was a good year for markets. We had pretty good returns from most of your growth assets. And it was a good year from our fund's perspective. We had a great year. We added a lot of value in our various different portfolios. So we call it alpha. So it's the outperformance of the indices and the benchmarks. And it was a good year. But towards the end of last year, we saw that buying protection on the portfolios was actually pretty cheap. So we started buying protection on the portfolios, and once we started reaching the beginning of the crisis, we actually ramped that up, and we bought a lot more protection in our portfolios and then took profits on that protection pretty close to the market lows. So that worked out very well for our portfolios. We were quite overweight in equities, so I think if we didn't have that protection, the outcome would have been a lot worse, but that was something that definitely worked from our perspective. The other thing that we did was we did move a lot of exposure from South African equity into global equities. And the reason for that being, it was part of the reason why we bought protection as well, is if you looked at global equity markets, they were getting quite expensive. And there weren't a lot of opportunities out there. You had to be very selective about the stocks that you were actually buying in those portfolios. Now, when we got to the beginning of this year, we started seeing a lot of opportunity in South African equities, particularly the global stocks listed in South Africa. And then once we moved into the crisis, what we saw was a lot of those global stocks that before were looking quite expensive took huge knocks in terms of their capital values. And we then started buying some of those stocks. And we also used the opportunity to increase the quality of the portfolio. So what does that mean? It means that in the portfolio, at any point in time, there are a number of stocks that we hold where the valuations look very good, but there are other stocks that the valuations don't look that good, but they are great stocks. They're good management companies. They are businesses that we would love to own, but they're just too expensive. Now, going into the crisis, a lot of those companies actually became incredibly cheap. So we used the opportunity to buy a lot of those good quality companies that normally are quite expensive that were now trading at big discounts to what we thought their fair values were. Another thing that we've done in the portfolios is with the rand having blown out to the extent that it has, we used the opportunity to actually increase some of our hedging on the currency. So above 18 rand to the US dollar, we have hedged because we do think that the rand is quite weak. Our fair value for the rand is lower than where it trades at the moment. And the point that at the bottom of the slide there, talking about cycling the portfolio, that was really moving from stocks that we thought were either overvalued or where we saw better opportunities. We moved out of certain stocks that were holding out quite well. So a good example there is something like a Richemont. At the beginning of the crisis, Richemont was a stock that held out quite well. We eventually sold it because we thought, well, this is going to be one of the stocks that's going to be really badly impacted if you go through a big recession, if there is a limit in terms of luxury spend. So remember, Richemont is a lot of luxury brands that they sell throughout the world. So if you don't have people traveling traveling, which is normally when they buy those sorts of brands. And if you have an economic recession where people aren't spending a lot of money, that's going to be one of the stocks that's going to be impacted. So while the share price was holding out, we sold out of a stock like Richemont, and we bought into other companies that were already experiencing big drawdowns or big declines in their share prices. A lot of the stocks that have done well this year that we've got in our portfolios, like the British American Tobaccos and Naspers of the world, they've done incredibly well. They are now big components of our portfolios as a result, and we will at a point in time take some profits there and cycle some of that money into what we call the COVID casualties. Some of the companies that haven't really recovered that well, that have taken a big knock in terms of their capital values. But what we will always ensure is that our focus is on the long term. We're not trying to time markets. We will use valuations as our guide in terms of what should be in the portfolios. And we won't just try and time markets in the very short term. If you use valuation as your guide over a longer term period, ultimately you should be rewarded for taking those actions. And then just a very last slide on the crisis. A lot of people have spoken to us and have said, well, we've never been here before. You always get those dangerous 4 words in markets. This time is different. The reality is, during the global financial crisis, people said the same thing, but I just thought I'll show a couple of headlines from the global financial crisis for those that are feeling a little nostalgic and thinking that we haven't been here before. We've seen big market dislocations before. We've seen very severe downturns in terms of economic activity before, and this is going to be no different. Ultimately, we think that long term we will come through this, and if you are diligent in terms of your buying during a period like this and taking advantage of opportunities, you will definitely be rewarded. So let's move on to South Africa. I think that a lot of people have loads of questions about where South Africa is, where to from here. And I think it's key to just make the point that going into this, we were already fairly negative on South Africa. Now, we went into this, we were placed on lockdown, that's been extended. In effect, most people are saying that we've gone from lockdown level 5 to level 4 3/4. Most people are actually still at home. So it's pretty much still a continuation of lockdown, and it's had a huge impact on our economy. Developed markets have also seen an impact, but in emerging markets such as ours, where you have huge disparity in terms of wealth and there's inequity from that perspective, it has a far bigger impact. And it's going to have a massive impact on the fiscus from a government perspective. So I think that we're probably in this for a reasonably long period of time. During all of this, during the crisis, Moody's finally downgraded us. And a lot of people were waiting for that. They were talking about the fact that when Moody's downgrades us, we're going to see bond yields shoot out. Now, the reality is at the height of the crisis, at the height of the declines in markets, we'd already seen bond markets decline by 3 times what we thought may happen if Moody's downgrades us. So the downgrade actually ended up being a bit of a damp squib. Not much really happened there. The markets had already declined quite significantly, so we haven't seen much impact from the Moody's downgrade. And subsequent to the Moody's downgrade, which hasn't really made front page news as a result of many more newsworthy stories to talk about, has been that Fitch and S&P have actually downgraded us further. So we are already, they did already have us at junk status. They've downgraded us further, and that is unfortunately less of an event, or maybe it's fortunate that it's less of an event now, because once you slip from investment grade to sub-investment grade, I think people are less interested in what happens next. But it does just show that the impact on our economy is quite significant. We've seen a couple of rate cuts already, quite significant rate cuts, 2 cuts of 100 basis points or 1% each, and we do anticipate that there may be more cuts to come. And from our government's perspective, the stimulus that they've been talking about does rely on some external stimulus. We have been talking to IMF, World Bank, New Development Bank for assistance, and that's also going to hopefully assist us through getting through a fairly big economic downturn. One of the potential positives was that if you go through a period of lockdown, there would be less electricity demand, and we thought that might be quite good for Eskom to allow them to do a lot of the maintenance that they needed to do. In subsequent discussions with Eskom, the biggest problem they've got is that a lot of the equipment that they need comes from global suppliers, and those global suppliers at the moment are struggling to get anything to them. So unfortunately, that deep dive maintenance that they need to do hasn't really been done. They've been scratching the surface. They have been doing some maintenance, what they can do, but unfortunately, the benefit that we thought we would have from that has actually been significantly less than anticipated. So when we went into this, as I said, we were very negative on the long-term of South Africa from an economic perspective. We were already on a knife edge, and having gone through the lockdown, going through this crisis at the moment, we think that there is the potential for fairly significant and irreversible economic damage. So we think that if you lift the lockdown and you go back to the way things were, that's probably not going to happen. It's going to be a very gradual process. To a large extent, a lot of the damage is done at this stage. And the stimulus package that was announced, as much as it was lauded, 500 billion, it's a fairly significant amount. If you actually go and have a look at the details of that, it's not 500 billion. No one's writing a 500 billion check, which is being injected into the economy. Some of it is tax breaks, some of it is guarantees. So 200 billion of the 500 billion is actually guarantees to the banks for certain loans that they make. So what the government is saying to them is, go ahead and continue to make your loans up to a certain percentage. We will guarantee that you won't make losses on those loans. So the reason behind that is to ensure that the banks continue to operate, that they continue to lend money into the economy, and particularly to small and medium enterprises. So the big issue we've got in South Africa going into this, and I think it's been exacerbated by the lockdown and the crisis, has been confidence. This is a business confidence index. The blue line there is business confidence. The greenish line, or light green line, is basically investment. So it's gross fixed capital formation. That's what businesses invest into South Africa. This was updated up to just about a month ago. If you look at updated figures right now, business confidence has actually dipped further. And we're now sitting at 35-year lows in terms of business confidence. And that is one of the big drivers of economic growth, is if businesses aren't investing into your economy, you certainly aren't going to see economic growth. And with business confidence as low as what it is at the moment, that's certainly going to have a lingering impact on our economy. So let's talk a little bit about portfolio positioning. And I've just included a quote there from a guy by the name of Doug Cass, who's a hedge fund manager in the US. And he said, when the time comes to buy, you won't want to. And I think it's so true. If you think back to just over a month ago when markets hit the absolute low point, which was towards the end of March, it was very difficult to see the light at the end of the tunnel. People were exceptionally nervous and were very scared of actually getting into the market at that particular point in time. And that was actually the point when it was time to buy. So it is difficult. We do understand that. And hopefully the partnership with your financial advisor and with a good manager will get us through that and will ensure that the portfolios are protected and that the opportunities are being taken advantage of. So what have we done in our portfolios? I've touched on one or two of these points already. The global exposure within our portfolios has increased. That's as a result of valuations looking a lot more attractive in the offshore space, and us taking advantage of that. And of course, with the Rand devaluing, that's also increased the exposure. So in a fund like our Balanced Plus, which is a Regulation 28 fund, so it can only have 30% offshore, we've got around about 27% plus exposure in Africa. It takes us to just over 30 at this point in time. As I said, we have hedged some of the currency at levels over 18 Rand because we are a little bit concerned that the Rand is quite undervalued at these levels. Within the South African equity context, it's important to differentiate. We view the South African equity market in two buckets. The one is global stocks, so in other words, global stocks that are listed in SA, and then we have the domestic stocks, the ones that actually operate in SA and derive most of their income here. And the bulk of our portfolio at this point in time sits in global stocks. So those are stocks that derive their income internationally, but they are listed in South Africa. And if you have a look there, we always compare to the index. We're currently sitting with exposure to the SA economy of around 28% versus about nearly 40% in the index itself. And that's one of the lowest levels that we've ever had. So the level of global stocks in our portfolio at just over 70% is the highest that it's ever been in our equity mandates. So I think that's quite an important point to make. Within the South African component, then, you obviously have stocks that are very economically sensitive and those that are a little bit more defensive. And we've been avoiding the ones that are economically sensitive. So if you think about companies that are exposed to leisure or construction, those are clearly sensitive to what's going on at the moment and economic cycles. Whereas something like a retailer or a food retailer or fast-moving consumer goods companies, those are a lot more resilient. And those are the types of companies that we've included in our portfolio. So avoiding those more economically sensitive cyclical type stocks. As far as South African property goes, I think this has been one of the areas where we've seen a real bloodbath. It's been very, very poor operating environment for them. And we are now in an environment where it's gotten worse for them. The balance sheets of these companies are fairly highly leveraged. So they've got quite a lot of debt. A lot of the companies have got quite a lot of debt. As the value of their properties declines, as their stock values decline, that debt as a percentage of the value of the portfolio, or as a percentage of what it's trading at in the market, becomes higher. And as a result, we're now reaching a point where, with the tenants in the building sort of saying we can't pay at the moment because we're not trading, you're seeing this big crunch in the property sector. So it really is the perfect storm for them. And the net result is going to be a postponement of dividends. So in effect, what's going to happen is property companies and the REITs in South Africa in particular have always paid out pretty much all of the money that they take in from tenants. And they're now going to be taking a holiday. So, if you hold property stocks where you had a 8 or a 10% yield, you're effectively going to have a 0% yield from those companies for the next 12 months, potentially longer. Now, that's quite significant. And it means that in the property sector, we have to be very careful around what exactly it is that we're buying there. So there may still be opportunities there. We are doing a lot of work around analyzing the companies, but it is an area where we are quite concerned, and it's quite uncertain at this point in time. We've built up a position in South African bonds with the market crisis and with the drawdowns that we saw. Bond yields shot up, and all of a sudden you could buy, a 10-year bond in the region of over 12%, which, if you compare that to where inflation is at around about 4%, the real return, in other words, the return above inflation, was the highest we've seen in decades. And that created a great opportunity. So we did build up a position in South African bonds, with the yields having pulled back to an extent. The 10-year yield from over 12% is now back down to somewhere around about 9.5%, which we think is a lot closer to fair value. We will start to sell some of those, but we just think that there was a great opportunity there. So that was something that we also did during the crisis. And just to give an idea of the disparity and why we did that, if you look at these two lines there, the dark blue line is the South African government 10-year bond yield, and the greenish line there is effectively the short-term yield. It's JIBAR, which is a 3-month yield. And if you look right at the end there, you can just see a huge divergence between the two. Now, on average, the blue shaded area at the bottom sort of shows you when bond yields are higher than cash, it's above the line. When cash is higher than bonds, it's below the line. There have been times where cash yields more than bonds. It's normally when interest rate cycles are turning. But on average, bond yields should be 2% higher, 2 to 2.5% higher than cash. And you can see right at the end of this table, where my cursor is pointing there, they shot up to around about 5%, which is huge. So we just saw that as a big opportunity, and we are seeing this gap closing at the moment, which is positive for portfolios. As far as global bonds are concerned, I think an important point to make here is that global bonds, that blue line there is the yield on US 10-year treasuries. You can see how from the early 80s, it's just gone one direction. It's gone down the whole time. And with bonds where yields are going down, effectively your capital values are increasing. So it's been a 30, 40-year bull market in bonds internationally. And that's why we don't hold any government bonds in our portfolios at the moment. We just think that when you're yielding close to zero, there's only one way from here, and that's going to be up. It might not be today, it might not be in the next year, but at some stage it's going to go up. And when it does, your capital values will decline. So we don't hold global government bonds in our portfolios. And then just on local equity, 2 points that I want to make. So this is a comparison of our house view equity portfolio to the index. And as I said earlier, the exposure to the SA economy is extremely low at this point in time. And we use the opportunity to increase our holdings in high quality businesses. So where you've got two businesses that you can invest in. One's high quality, the other one's maybe not as high quality, but it's on a much lower valuation, and the high quality business trades at a premium. You probably invest in the slightly lower quality business with a lot more upside. Where both of those stocks and that you always want to have in your portfolio. Then I've just put a slide here on, it's our top 20 fund, the top 10 holdings. All I really want to highlight on the right-hand side there is the upside that we see in these stocks at the moment is significant. And the dividend yield in that portfolio is over 4%. Now, a lot of people look at that upside and they go, well, you know, that's just your opinion. So we actually developed this graph. The shaded blue area is the upside in a fund like Top 20 over time. And then the blue line is the next 24 months return, and the green line is the next 36 months return. So you can see the correlation between the time and how over the last while there's been a breakdown in correlation. So we see the highest upside, over 70% upside in that portfolio at the moment, highest upside that we've seen for decades, yet the returns that we've seen over the last 2-3 years have been quite poor, as everyone has seen in the South African market. So at some stage, we think there will be a reversion, and that this upside that we're seeing at the moment will play out over the next couple of years, and hopefully that will boost the returns for investors in our multi-asset class funds and those holding growth assets. So just the last couple of points, and these are just final thoughts for investors. The first one is that we hear a lot of people saying, well, we're going to time the market, or when things were going badly, they all said we're going to get out now, but we'll get back in again when it gets better. And I'm sure all of you have seen some version of this. If you are invested in the market, and we've taken a period of nearly 20 years, 6,234 trading days, if you invested for that whole period, you would have made nearly 15% per year. If you missed just the top 25 days, all of a sudden your return halves. If you miss 50 days, halves again. If you miss the 75 best days, you actually have no return over a nearly 20-year period. And if you miss the best 100 days, you actually have a negative return. So I think most people get this and they say, okay, well, you clearly don't want to miss the best days, because sometimes the best days are quite significant. You have days in the market where market's up 3, 4, 5%. You don't want to miss those, but those generally happen in bull markets, and that's not the case. So here's that whole series of returns broken down into daily moves. And immediately what you'll see is that sometimes when you've had the biggest moves, it actually almost coincides with the biggest losses in markets at that point in time. So you have these big down days, and the really big up days are right after the down days. So coming here to March, this was earlier this year, you can see we had some huge down days, but some of the biggest up days we've ever seen happened literally the day afterwards. So people that say they can time markets, you would almost have to time on a daily basis to get it absolutely right to the day if you wanted to time markets accurately. And we don't think that's the case. We don't think that there are many people that can do that. And we think it's inappropriate for people to try and time markets on that basis. Granted, at a point in time where you see that sort of value, we may have been buying purely on a valuation basis, not because we're trying to time the market, but just stocks that we thought are worth X, we're trading at X minus 30, 40%. That's probably a good time to buy. So first point there is just trying to time markets is a really bad idea. Second point is that you have great long-term outcomes. So this is just a simple graph of our balanced plus fund over time. And you can see over a more than 25-year period, you've had a great outcome. It's gone up and it's done very well. The return that you've got out of a fund like this has actually been equivalent to what you got out of equities at a much lower level of risk. So that really is the holy grail of performance. But if you go and you analyze over very short-term periods, we've seen crises like this before. Emerging market crises at the end of the 90s. We saw the dot-com bubble burst in the early 2000s. We've been through cycles as a result of significant rate hikes and cuts. Global financial crisis in 2008, 2009. Yet the performance, the overall return that you've got throughout that, taking into account those crises, has actually been very good. So sometimes you do just have to sit through a difficult period in order to get those returns. And then just my very last point, last slide, which I think you have seen some sort of a version of, is that when you go through these big drawdowns, there's periods directly after those. So, you go through a crisis, you see a big drawdown in a portfolio. The subsequent periods are generally very, very good. And here you'll see that third column that says drawdown. We've taken various periods over the last couple of decades and shown what those level of drawdowns were. The next column shows you the recovery time. And on average, the recovery time is not that long. You know, you're talking about 1 year, 11 months. So call it 2 years of recovery time, sometimes a lot less, sometimes a little bit longer. And then you can see your next 1 year, 2 year, 3 year, 5 year, 10 year returns on average are fairly significant. You know, so if you take from that low point over a 1 year period, over a subsequent 1 year period, on average, 62% return, which is significant. And we don't think that this is going to be any different. You know, if you measure from the low in March, a year from that point, you'll probably find that it's going to be something similar. So the 3 points really are trying to time markets, we think is incredibly difficult. You have to sit through some of these tough times sometimes in order to get the long-term return. And often the recovery is quite quick and the returns that you see from those low points are quite significant. So selling out at those low points, we think is very dangerous. So just to conclude then, this is a difficult time. A lot of people are fairly anxious and fairly scared of what's going on out there. What we're worried about is people that make knee-jerk reactions in these times. You know, knee-jerk reactions end up being shown up for what they really are over a longer period. So you do something and maybe in the short term it makes you feel good, but in a year or two's time you generally regret it. And it's at times like these where having a good manager, good multi-asset class portfolio with a good manager that is making calls on your behalf is very helpful, and having a good financial advisor. Progressive Wealth been in the market for a long time. They've seen these things before. They know how to hold clients' hands and get them through these times and avoid making any big mistakes. So that's absolutely key for us. Avoid knee-jerk reactions. We continue to look for what we call the best risk-adjusted return. So we're not just going to buy something that's got huge upside just because of the upside. We will always take into account the fact that there are risks that come with that upside, and you need to find a balance between the two. You can't just go for the one because you see a stock that's got 200% upside. There may be a very valid reason why it's got that sort of upside. So being able to sort between those types of stocks in a period like this is absolutely critical. And it takes a lot of discipline. So we've said this earlier on in the presentation. We look at the long term, and in order to look at the long term, you need to be disciplined. You can't let the noise that's happening around you at any particular point in time affect your decision making. You need to be very pragmatic about what it is that you're buying, and you need to make sure that the potential risks there are priced in. So if we stay focused on the long game, ultimately we think that you as investors will be rewarded. And I thought I'll just end up with this quote by Dr. Abdu Shakaway. So he is an infectious disease specialist at the University of Toronto. And I think that this quote applies not only to the situation that the world finds itself in, but certainly to markets as well. Being patient, making sure that you've got, if you don't have the education yourself, that you've got somebody with that education who can either assist you or can hold your hand through the process. That's my presentation. Thanks very much for listening, and thank you for taking the time.
Thanks, Peter. I think we'll hand over now to Marise.
Hi, everyone. Thank you for the opportunity to share our views and thoughts with you during these uncertain times. I know that the temptation to disinvest and just wait on the sideline for things to improve is real. And hopefully my message will give you the reassurance that this uncertainty we are currently experiencing too shall pass. And I would like to start off by giving you context about how serious the economic downturn is, as Peter alluded as well, and that the world, is in a tough spot. And then I would like to speak about our portfolios, opportunities specifically, and where we see potential returns. So many people aren't aware of how severe the economic downturn has been. Firstly, I've used mostly US economic indicators here because it's more real time. They give weekly numbers, while for many other countries, it's lagged by a quarter or a month. And here you can get a feeling for how quickly things have slowed down. You can see the US fuel demand is down 37% from where it normally is. It's back to levels last seen in the 1960s. And this number is even more drastic in South Africa. In actual fact, Google Drive stats show that car usage in South Africa is down 90%. So the severity of our lockdown means that the activity in South Africa has slowed by more when compared to other countries in the world, which is quite frightening. But the real tragedy is in job losses. So the real human aspect of what is going on is indicated by this chart, which is a weekly number of initial jobless claims in the US. And you can see the spike on the far right is 6 weeks of all data stacked together. And the highest increase in claims is 7 million in a single week. But in total, 30 million people in the last 6 weeks in the United States have claimed unemployment benefits. In other words, they have lost their jobs. And then you look at a place like France, they've got about 20 million people that work for the private sector, and 10.2 million of those are being paid by the government at the moment. So more than half of the private sector employees in France are being paid by the government at the moment. Unfortunately, we don't have similar data for South Africa, but given the severity of our lockdown and given just how informal our economy is, if you think of the percentage of people who have lost their income or could be losing their income, it would probably be more on the severe side of countries globally. And unfortunately, we do not have a social security net like many of these developed countries. So there are many millions of people in South Africa experiencing extreme hardship. And the same goes for businessmen, business owners, who do not have the cash flow to pay their people. Then looking at the government's reaction to it, and maybe just to take a step back quickly. So the economic downturn we've seen is the sharpest since at least 1929, that Peter also alluded to. And even in 1929, during the Great Depression, economic activity did not fall as fast. For sure, it fell for a long time, but it didn't fall as fast. And government strategies have changed a lot over the last couple of years as well, in particular since the global financial crisis in 2009. As I'm sure you know, many, if not most, governments around the world have announced huge bailout plans. And this data here is actually from Deutsche Bank from 2 weeks ago. The cumulative stimulus packages now exceed $13 trillion that have been announced in the last couple of weeks, to try and limit the effect of lockdowns on people's lives and those of businesses. If you contrast that to just the $2 trillion, which took a whole year during the global financial crisis, so that's 6 times the number. What this means for currencies, asset markets, government bonds is extremely interesting. And I suppose the big question remains, what will the result of these bailouts ultimately be? And there are 2 sides to the argument. Many people argue for inflation. You're printing, creating a huge amount of cash. The only way out of this is to inflate your way out of it. While other equally astute people argue for debt deflation, where the amount of debt in the world crushes economic activity and the weak demand side means prices fall, similar to what Japan has been experiencing for the last 20 years. So both strong arguments, inflation, debt deflation, and neither of them good scenarios. Moving a bit closer to home, to South Africa. South African government has recently announced a stimulus package of 500 billion, as was mentioned before. Here are our estimates of government or the fiscal deficit borrowing requirements for 2021. And in actual fact, it could be worse than this. SARS said this week they expect tax collection to decrease by 250 billion. So you could be looking at almost a 1 trillion budget deficit. But let's say South Africa runs a 700 billion budget deficit in the next 12 months. That is 230,000 Rand per taxpayer. So an additional government debt of 230,000 Rand per taxpayer just in 1 year. There are about 4 million taxpayers in South Africa, and I know that personal income tax is not the only tax, but in 2019, personal income tax accounted for 38.3% of total tax take. But nonetheless, this is the main place where the government can go for additional tax revenue, and it gives you a sense of the potential burden. Now, people know that South Africa is probably in a particularly bad place. Why? Because our economy was weak going into this situation. The level of shutdown has been amongst the harshest globally. And you can see that coming through the rand as foreigners sold our assets, sold South African bonds, sold our equities, taking the money out, and you see the rand weaken. In actual fact, year to date, it is the second worst emerging market currency, and it's been weakening about 25% since the 1st of Jan. Now, this is just to give you a bit of context on the macro picture. And now I'm going to move to our funds. So what's happened with the main Allan Gray funds? Looking at our own funds, drawdowns have obviously been disappointing. You know, we look to achieve real returns for clients, real returns meaning we want to beat inflation at least. And I've put charts here of the total return index for Allan Gray Balance and Stable Fund, our two largest unit trusts. And over the past 3 years, just to mention this data is until the 29th of April, the Allan Gray Stable Fund returned just over 4% a year over the past 3 years, which is clearly disappointing. We aim to give our clients real returns of at least 3 or 4% to create wealth for them over a longer period of time. Similarly so, if not more so, if you look at the Allan Gray Balance Fund, only doing just over a 1% a year for the last 3 years. I mean, that being said, asset class performance in South Africa has been weak. The bond market sold off. The stock market, as you can see there, including dividends, has only given investors 1% a year for the last 3 years. And the property market also being weak. Then looking at the short term, the year-to-date numbers. The Allan Gray Stable Fund is down just under 3%. The Allan Gray Balance Fund just over 5%. That compares to the stock market falling by 10%. But importantly, you can see on the graph that very sharp drawdown and then recovery through April from the lows of March. And there are just two things that I would like to mention here. The one is we are obviously pleased that asset prices recovered quite sharply, even though we know in the back of our minds that things could get worse before they get better. And this, all asset prices fell across the board, whether you were in government bonds, equities, etc. So there was a very high correlation between assets. So this does show you that one should avoid and not panic when you see the price of something fall. No, it's about the underlying value. And for sure in Stable and Balance Fund, the prices fell more than what we would have liked. We would have liked no price fall at all. But at least if you didn't sell at those low points, prices have recovered somewhat since the 3rd or 4th week of March. Then what are the expected returns going forward from here? And looking at Stable Fund, people asked, you know, why was the drawdown so large? Is the fund fairly aggressively invested? What are you invested in? What are the opportunities? And I've tried to indicate that here by bucketing the assets in the portfolio into 3 separate buckets. You've got low volatility in green, and then moderate in blue, and high volatility in yellow. And then looking at the expected returns for each of those groups and the underlying asset classes. So if you look on the right-hand side, in the Stable Fund, for instance, about 11% of the fund is invested in rand cash, which should give you about 6%. About 2% is invested in US dollar cash. And then a third asset there, inflation-linked bonds. It is one of the things we bought the most aggressively in the last couple of months. Why? Because the price fell a lot. Inflation-linked bonds now account for 10% to the portfolio. And I will get to the value of those in just a second, but it's probably the lowest risk asset you can buy. And we've got some precious metals in the fund. And as you cast your eye down, you can see African US dollar debt, some hedged equity, and finally in the higher volatility, you've got some South African equity, South African property, etc. So you can see the expected returns from the high volatility category, the yellow category, are extremely high. I mean, we expect 20% from South African equities, African equities 25%, Orbis or offshore stocks 15%. And just to mention as well, our portfolio managers are usually pretty conservative in giving expected return forecasts. So if you had spoken to any one of them 4 years ago and asked them what their return expectations is for our market, they would have said inflation, you know, or something like that. Why? Because prices were quite high 4 years ago. Today, prices are quite low. So if you work out the weighted average of all of this, the expected return from Allan Gray Stable Fund is about 12%. And you contrast that with inflation of 4.5% at the moment. So a very healthy return. We think assets are cheap and we are excited about the potential returns. And then this is the same data for Allan Gray Balance Fund, but I'm not going to go through it in any detail. Just something that I want to mention, you will see a greater portion of the fund allocated to the higher volatility assets, that yellow part. But just something to remember is that higher volatility does not mean higher risk. Buying a very volatile equity that is very cheap is actually very low risk. Why? Because there's a very high chance it is going to go up. No, it's all about the price that you pay at the end of the day. Conversely, cash is a very low volatility asset. And in the case with hyperinflation, cash loses all its value. So then it's extremely high risk. So you need to be cautious about equating volatility and risk. You know, they are not the same thing. And then looking at the Rand, it's a very important driver for South African investors. It's South Africa's biggest shock absorber, like we often say, because we benefit from exports. You know, many companies earn dollar earnings, etc. The question is it weak or expensive? We think it's weak. And this is the Rand. This graph shows the Rand against the dollar in purchasing power parity terms over the past 25 years. And what does that mean? It's basically comparing the price of goods in South Africa with those in the US. And you can see how weak the Rand got in 2001 as the line moves up when it sold off. And you can see the global financial crisis in 2009, Nenegate in 2016, and then today. So looking at purchasing power parity, for sure the Rand is weak. And in actual fact, we have repatriated assets from Orbis, our offshore partner. South African asset prices are cheap, yes, but we will not bring back the full 100% offshore exposure because risks are still high in South Africa. You know, there's a reason why assets are cheap in South Africa. And then the other important thing to remember about currencies as well is that the situation is bad in South Africa. There's no doubt about it when you look at our physical, political situation. But don't forget that currencies are measured relative to one another. And in the US, they also have a big physical problem. They are running huge physical deficits. But that being said, being a developed market country, they have other privileges when it comes to emerging market countries, especially the fact that the US is a reserve currency, the US dollar. And now moving on to asset classes. So I've got two charts on bonds. And basically a bond is where you loan money to a company or government in return for an agreed rate of interest. So the first one here is the 15-year South African government bond. And the yield to maturity is on the right-hand axis, that's the red line, and the price, the gray line, on the left side. So what it shows you is if you buy the South African 50-year government bond today, you will receive a return of 11.7% per year if you hold it to maturity. If you bought it 3 months ago, you only got a 10% return to maturity. Now, how did the yield go from 10 to 11.7? The price fell. The price fell from 90 to 70 cents and subsequently recovered. Why did the price fall? And it's partly been as a result of the deterioration in our economic outlook, but also because our bond market is particularly liquid compared to some other emerging markets. So it's been a lot easier to sell our bonds and put money in safe havens or revert to the US dollar. And this also speaks to the drawdown you saw in our stable fund in particular. So what is the real return? You know, the return that takes into account inflation that you can get from this. You get a nominal return of 11.7% over the next 15 years. But what's the real return? And that depends on inflation over the next 15 years. If inflation remains flat at 4.5%, you're going to get an exceptional return of 7.5% real. If inflation spirals out of control, and let's say it goes to 12% on average, that is 12% for the next 15 years, your real return from this asset will be 0. So it does depend on what you think inflation is going to be. But we think at Allan Gray, there's a very big margin of safety priced into this and have therefore been steady buyers. In actual fact, our exposure to South African government bonds is the highest it's been for a very long time. And then on the other hand, inflation-linked bonds are far lower risk. Why? Because inflation doesn't matter here. Here we look at the real yield. So we don't look at the nominal yield, but the real yield. What do you get after inflation? You can buy a 10-year inflation-linked bond today at a yield of 4%. So if you hold it to maturity, you will receive 4% above inflation guaranteed over the next 10 years. And a 4% real return is extremely attractive, especially the fact that it's guaranteed. So you can see for most of this bond history, people were happy to accept only a 1.5 real return. I mean, that was whilst Zuma was in charge, and it's not a great return. But in actual fact, in March, the bond market got extremely dislocated and we were able to buy inflation-linked bonds at real yields up to 7%, which is truly an exceptional return for very low risk. And therefore, inflation-linked bonds are one of the most preferred asset classes in our Allan Gray stable fund. And then moving on to equities, it hasn't been a good asset over the past 5 years. It basically underperformed since 2011 versus global numbers. And the South African equity market is actually very misleading. Why do I say that? Because it's dominated by one stock in particular, Naspers, and 4 stocks altogether. So Naspers, Richmond, Anglo American, and BHP Billiton account for about 50% of our market. So of the all-share index, those 4 stocks account for half, and the other are 163 stocks, the remainder. So actually year to date, those 4 stocks are up. The remaining stocks on average are down 25%. And in actual fact, if you look at the last 6 or 7 years, the vast majority by number of shares in South Africa are actually down. Let's call it 20%. While those big 4 stocks, if you haven't owned them, you have done terribly because they are up 60% over that period. And at Allan Gray, we are fortunate enough to own a big portion in Naspers. We don't own Richmond. We think it's somewhat overvalued. And we've chosen to own Glencore over BHP and Anglo American. And you can therefore see this huge divergence in return between domestic South African shares and the global stocks, like Peter mentioned as well. And where we are finding value is in domestic cyclicals and your domestic financials. And yes, they have done poorly for a while. We saw the value in January already, and that's why we have higher share weighting going into COVID-19. But having said that, we haven't piled in as much as usual due to the substantial risks facing South Africa. And now looking at some of the individual stocks as a percentage of our Allan Gray Balance Fund, and more particularly looking at the largest 11 holdings in the fund. The share weightings are not dissimilar in the equity portfolios or the stable fund, but what I've done is I've shown you the year-to-date numbers or returns, and you can see the huge contrast. For instance, Naspers is up 26% in green year-to-date. But if you look further down, Nedbank is down by half year-to-date. So for Nedbank, that's total return. And I mean, Nedbank has paid a big dividend. So actually the price return is even worse. British American Tobacco, Naspers, the top 2 are still trading at very attractive valuations. They're big, liquid, globally diversified shares, and they've managed to hold up quite well. But what kind of valuations are you looking at here? And it's kind of self-explanatory. We think there's compelling value, particularly in South African stocks. Stocks like Nedbank trading at 4.5 times earnings. That's basically how much an investor is willing to pay for R1 of earnings. They're willing to pay 4.5 times. Old Mutual is on 6 times. Woolworths trading at 7 times. Whereas in 2015, just 5 years ago, it was trading on 25 times. So compelling value, and that is what gives you the confidence that returns are likely to be good over the next 4 years if you buy these undervalued companies. And yes, the market might not recover as quickly as 2009, but we still think there's exceptional value and great opportunities. And the comments on the right, on the right table, or the right column, it just shows you why we're finding value. And then right at the bottom, you'll see we've got Sasol there as well. And it's been by far our biggest attractor over the last 2 years. Yes, the share is very cheap, but obviously there's extreme risk as well. So many of these businesses have risks, and we think these businesses will survive. and even thrive going forward. And then there are many ways just to get a sense of the value of the market, you know, from a top-down level. And looking at value, dividend yield is one of them. And what the dividend yield does is it shows how much a company pays out in dividends each year relative to the share price. And then that's expressed as a percentage. But you can also look at price to book, price to earnings. You know, there's quite a few metrics that you can have a look at. But I've chosen the dividend yield here. And why do we show the JSE dividend yield excluding Naspers? The reason is Naspers accounts for 26% of market and it doesn't pay a dividend. And 10 years ago, Naspers accounted for basically 0% of market. So if we include Naspers, it distorts the numbers somewhat. So that's why we've excluded it here. So this is the dividend yield of the other 166 stocks in the all share index, and it's trading above 5%. And historically, if you bought the market on this kind of dividend yield, what kind of returns did you get? In 2003, when the dividend yield was also high, when you bought the market at that yield, you got 36% per year for the next 4 years total return. Similarly, in 2009, you got 24% per year for the next 4 years. So that's pretty out there returns. Do we expect those kind of returns? No, we don't. Why? Because South Africa is in a far worse place than it was in those two previous points in time. We think the earnings recovery will be far slower. But what I will say is when you buy stocks at this kind of valuation, you have history on your side, and history indicates good returns from here. And then just maybe something to note as well is sometimes when you look at the total, you know, from the top down, you don't see the underlyings. And the way we do investing at Allan Gray is we look at specific businesses. For sure, we look at the big macro picture overall to see the risks. But when we are buying assets, we are valuing particular individual assets from the bottom up. And then the next question is where to from here? Having a plan and a process in place to achieve your goal is key, like you've probably heard before. And because most of you are lucky enough to have a financial advisor, you already have some sort of financial plan in place that helps you manage and prevent emotional decision making. But where to begin? So people often make the mistake of asking which product they need without realizing this is the wrong place to start. You know, you would never want to walk into a doctor's office with an ailment and then the doctor doesn't take the time to diagnose you. But you walk out with the prescription and you're not even sure it's right. So therefore, a financial plan is the critical starting point. You know, it forms the foundation of your decisions. And once your plan is in place, you can establish a process along with your advisor to follow that plan. And the process deals with how you will reach your destination and achieve your goals, even in times of extreme uncertainty, what we're experiencing right now. And then the final step is choosing your product. And inverting this triangle makes no sense, as you cannot choose an appropriate product until you know what you want to achieve. And then, yes, your life isn't static, so why should your financial plan be? And it's very important to remember to regularly revisit your plan with your financial advisor, just to make sure you're on track to meet your goals and to make sure your goals are still working for your reality. So your role then is to think carefully about your financial goals. What is it that you value? And in thinking about this, considering how you intend to reach your goals. And setting up a plan with your financial advisor to reach your goals will assist you in finding the right unit trusts or the right portfolio that align with your objectives. So well-considered investment decisions are based on your risk tolerance, your investment horizon, investment goals, you know, all of those factors. But these factors should not change due to the market movements. Of course, if your personal financial circumstances or investment goals change, it's important to check that your investment choice are still appropriate. But in the absence of change in your circumstances or goals, in most cases, no action is needed when there is market volatility. More often than not, trying to time the market, you know, leads to disappointment. And then I would like to end off by showing you an example, and this is by using Allan Gray data that illustrates the effect of leaving the market during a downturn. And in this case, it was during the global financial crisis in 2008. And it just shows how loss aversion or timing the market can negatively impact your long-term investment return. And in this example, there are 3 investors who invested 10,000 Rand each in the Allan Gray Balance Fund before the global financial crisis in 2008. 3 months into the crisis, Investor A, the grey line, decided to switch their investment into the Allan Gray Money Market Fund for the remainder of the investment period. Investor B, the black line, also decided to switch out of the balance fund after enduring 3 months of the crisis. And like Investor A, we also switched into the Allan Gray Money Market Fund, but only for 1 year, which seemed like a reasonable period to allow the dust to settle. Investor B then switched back into Allan Gray Balance Fund after 1 year and remained invested in the fund. Now, Investor C, the red line, remained invested in the Allan Gray Balance Fund for the full period and endured the market volatility. And then when you look at the investment values at the end of February 2020, we can see that Investor C, who made the difficult decision to remain invested in Allan Gray Balance Fund and to endure more pain in the short term, had the highest end value of 30,464 Rand, in contrast to the investors who switched into Allan Gray Money Market Fund. In addition, by remaining invested, Investor C did not experience any pressure or anxiety in trying to decide when to exit and re-enter the market. And this example just confirms that it's impossible to forecast the bottom of the market or fund performance during a downturn. I mean, like Investor A and B, we tend to wait for bad news to pass and for negative sentiment to turn positive before we risk re-entering the market again. And that's often to our detriment. And I just want to ask you, have you ever sat in traffic, in a lane that's not moving, and you watch people switch to the lane next to you that's empty? I mean, you're frustrated by your lack of progress and you're annoyed by all the people passing you. So then you end up switching lanes. And no sooner do you switch lanes when the traffic stops in that lane, but more often than not, you will arrive at your destination at close to the same time as someone who did not switch lanes. So this is exactly what happens to investors who chase this year's best performing fund. I mean, history shows that those who constantly change lanes to the year's best performing funds don't keep up with next year's overall average return. And then just to conclude, the risks at the moment are unusually high and it's different from normal. Normally, when we look at a business, we look at the company specific risks. In this case, all businesses, all people are facing the very same risk. And that is basically an economic depression or an extremely severe recession. And it's something you have to be aware of. But however, because of those risks, there is great value and people are pricing this into many asset classes. That is equity, fixed interest, inflation-linked bonds that I've spoken about. And that is why we've been accumulating these over time. But finally, with investing, protection of capital is paramount at Allan Gray. And yes, we realize that the Allan Gray Stable Fund and Balance Fund had pretty severe drawdowns, and we apologize for that. But we are thinking very carefully about how to protect your capital in many different scenarios. This includes one where you get inflation, like I mentioned before, or debt deflation. And we are adding to the portfolios in a responsible and a conservative manner. We haven't gone all in one strategy or another. And I know many people have been rushing towards cash because there's very low volatility. However, cash can be a risky asset if inflation picks up. And that is something you should be thinking about. And therefore, we have a preference for real assets, like equities at a very low price across our diversified portfolio. And that's it from me. Thank you for your time.
Marise, thank you very much. Peter, thank you very much as well. We're going to end the presentation with a very quick video. But before I do that, I'd just like to obviously thank Peter and Marise for today, and just find out if there are any questions from the audience. Please feel free to unmute your microphones and just jump in with a question. I was going to ask a question or two, but I think for the purposes of time and the fact that I think Marise and Peter, you've answered the questions I was going to ask anyway, I'll leave my questions. But just to reiterate, the sort of from both presenters today, the forward-looking returns do look very positive during this torrid time. Although obviously we are very cognizant of the fact that headwinds remain and there are risks, and certainly we will see continued volatility. But I think what's important to note is that everyone on this call, all of our clients, you are invested in portfolios that are made up of multi-asset funds, which you've now heard from Marise and Peter, are being managed by Allan Gray and Coronation and the other asset managers, that they haven't moved everything into cash. You know, if they thought that was the solution, they would have moved their funds into cash. Yet they maintain a diversified, balanced portfolio, and in many instances, they've actually upweighted some of the exposure to risk assets. But on that note, I just want to thank everyone from myself, Ronel, and Nico. Thank you for joining us. Have a fantastic weekend. Stay strong and stay positive, and we'll end on this video. Thank you very much.